Have you ever seen a hot new company about to go public and just wondered what you're really getting into? It can feel like you're trying to solve a giant puzzle with hundreds of pieces. Well, today, we're going to find the key that unlocks that entire puzzle. We are talking about the one document that lays it all bare, the red herring prospectus.
Okay, so here's our game plan. First, we'll break down what this document even is. Then, using a real company, Anondita Medicare, we'll see who they are. We're going to find out why they want your money, how that IPO price actually gets decided, and maybe most importantly, we're going to read the company's own list of everything that could go wrong. And then we'll tie it all together with what you can take away from this for any IPO. All right, first things first. Before any company can sell its shares to people like you and me, it has to file this monster document. It's officially called a red herring prospectus, or RHP, and yeah, it can easily run into hundreds of pages. It looks super intimidating, I know, but it's actually designed to protect you.
That is the million-dollar question, isn't it? And the answer is right here, in this document. An IPO isn't just about a new stock symbol popping up on your trading app. It's about a company making a legally binding promise to tell you everything about its business, the good, the bad, and the ugly, before they ask for a single penny.
So, to make this real, let's stop talking theory. We're going to use the actual RHP from a company called Anondita Medicare Limited to be our guide today. By the time we're done, you'll know exactly how to use these lessons for any IPO you're looking at.
So let's start our tour. The first stop is just getting to know the company. An RHP always kicks off by introducing the business, its history, and the people who are actually running the show. It's all about answering that one basic question. So, who are you guys?
You know, this timeline actually reveals something really interesting right away. This business has been around since 1999, but it only officially became a public limited company in March of 2024, just a couple of months before its IPO. So what does that tell you? It's an established business for sure, but it's a very, very new corporate entity.
Next up, the RHP tells us who's in charge. These are the promoters, the key people driving the company. And you can see right here, Mr. Anupam Ghosh, the managing director, holds almost 84% of the company before the IPO. That tells you, loud and clear, this is a promoter-driven, family-run business at its heart. All right, now we get to the heart of the matter. Why is the company even doing this? Why are they raising all this money? You see, it's not some vague request for cash. They are legally required to spell out exactly what they're going to do with the money in a section called Objects of the Issue.
Right on the cover of the RHP, you'll see this headline number, the total size of the IPO. Now, the final price isn't set yet, which is why you see those blank brackets, but this figure gives you a really good sense of the scale of what the company is trying to do.
And this chart shows you exactly where that money is headed. The lion's share, a whopping 85%, is for working capital. That's just cash to run the day-to-day business. The rest is split between capital expenditure, think new machines, and a little bit for general purposes. This breakdown is absolutely vital. It's basically the company's business plan in a picture.
So, this brings us to the next big question, right? How does a company even come up with a share price? Well, it's not just pulled out of thin air. The RHP explains the entire process.
Okay, this is a really important thing to get right. Face value, which is 10 rupees here, is just an accounting number. It's kind of meaningless for you as an investor. The issue price is what you'll actually pay, and it's going to be many, many times that amount. That final price is found through a process called book building, where big investors place bids, and that helps discover what the market is truly willing to pay.
The RHP also explains how you can apply, and the key system here is called ASBA. The days of writing a check and waiting for a refund are long gone. With ASBA, when you apply, the money is just blocked in your bank account. It doesn't actually leave unless you get the shares. It makes the whole process so much safer and more efficient. And now, we've arrived at what is, without a doubt, the single most important section in this entire document. Every company going public is required, by law, to include a risk factors section. This is where they have to tell you everything that could possibly go wrong. You should never, ever skip this part. Seriously, think of it as the company giving you a heads up on all of its weak spots. This is not just legal mumbo-jumbo. It is a detailed, specific list of threats to their business, their finances, and, well, your potential investment. It is required reading. For instance, right inside Anondita's RHP, they state this directly. Negative operating cash flow means that in the past, their main business was actually spending more cash than it was bringing in. That's a pretty big piece of financial information you probably wouldn't get from a news headline.
And here's another fascinating little nugget. This basically highlights a logistical headache from when the business switched from a one-man show to a proper company. It's telling you there's some financial paperwork that's still not sorted out, and that's a potential complication.
And you'll see, the risks they disclose cover everything. We've seen financial risks, like the negative cash flow. There are operational risks, because they're a new corporate entity. Market risks, like relying too much on just a few states for sales. And even regulatory risks, because so much of their business depends on government contracts. Reading this section gives you the full web of challenges they're facing.
So, we've walked through the key parts of a red herring prospectus. We've seen how a company introduces itself, explains why it wants your money, and even confesses its biggest worries. So, what's the big takeaway from all this?
It really just boils down to this simple but incredibly powerful checklist. The next time you look at an IPO, just ask these 3 questions. 1. Who's the company? 2. What's the ask? And 3. What are the risks? This framework will help you cut through all the hype and focus on what actually matters.
Look, the whole point of this was never to give you an opinion on Anondita Medicare. It was to give you the tools to form your own opinion on any company. That 400-page document isn't an obstacle, it's a map. And now, you know how to read it.
And that's the real power, right? It's not just about consuming information, it's about being able to ask smarter questions. When you can look at an IPO and immediately know to check the company's history, its use of funds, and its biggest disclosed risks, you're no longer just a spectator. You are an informed participant. Thanks for joining us.